Subclass 1.4, Motor Policy, Part 2. So where will you be covered? Territorial limits. Most insurers will cover the vehicle when used for private use in the neighboring countries of South Africa like Swaziland, Lesotho, Mozambique, Botswana, Namibia, Malawi, Zimbabwe. Additional benefits to comprehensive cover. So some of the most common cover extensions are wreckage removal. So sometimes with a limit to the amount that can be claimed. So your vehicle was in an accident, there's just a wreck, so they need to get the low bed truck to load the wreck and take it somewhere to be stored until the insurance is settled and stored out. A lock and keys, so costs following loss or damage up to a limit without affecting the no claim bonus discount. So policies will have a certain limit that they will pay for locks and keys which you lost. Tow-in charges following electrical or mechanical breakdown, medical expenses cover, trauma counseling, and emergency accommodation. Some insurance policies do have all these things included. For some is excluded, you have to pay extra. So it depends on your short-term insurance policy. Cover of unintentional violation of a policy condition. So something that you were not supposed to do, you unintentionally did it, and now you've got a problem. Shortfall cover. Yeah, if you finance a vehicle from the bank, the bank puts interest. So now the vehicle you bought it for 100,000, but with interest now it's 130,000. You owe the bank. Now you're in an accident and insurance pays you out 100,000. You're still short the 30,000. So you must get that. So that is the shortfall cover. They can cover you that extra 30,000 as well, so that you can settle the vehicle with the loan at the bank. Excess waivers, extended liability, contents of the caravans, windscreens, car hire, etc. So when you look at trade, retail, market, insured, and settlement value. So value is determined as follows. You look at the retail value. So what can you sell the car for? Market value, what is it worth in the market? Trade value is normally less because the car dealer will give you less because he needs to sell it at market or retail value. Nominated value, it's agreed value basis, and settlement value, settlement amount. What do you owe the bank, the finance institution? So let's look at each one of them. Trade value. It is the value according to the TransUnion Dealer's Guide that you should be paid by a dealer when trading your vehicle in, and this value is influenced by conditions of your vehicle and mileage. So it all depends. So you want to buy a new car, and you want to trade in your old car for the new car, but they are not going to give you market value because they need to sell it for market or retail value. So they're going to give you less. That's why they talk about trade value. Sometimes they can add on a bit more because if they make enough commission on the new vehicle you're going to buy, they take some of that commission and to lift the trade value. I know I've got friends that's in the industry, they told me then they will give you more than trade just to get the deal done because they're going to get a lot of commission from the new car you're going to buy. So they're willing to sacrifice some of the new commission there and add some of the trade value to give you better deal just so that you go for it, and then they had to have you. They got you hooked. Retail value. Current selling price of a vehicle at the dealer according to the TransUnion Dealer's Guide. So what are they selling for currently? The retail value will include factory fitted accessories. So the vehicle's age, condition, and mileage might affect the value of the vehicle at time of lost market value. So you work out the average between retail and the trade value. So the retail plus the trade value divided by 2, that's your market value. So let's say, for instance, your retail value is I'm just taking an example, 100,000 for my VW Polo. Okay, that's what I'm driving. So, and my trade value, let's write it here. My trade value, let's say, okay, if I trade it in, I can get 80,000 for it. So what is my market value? And now the formula here says you take your retail, which is 100,000 rand, plus your trade value, so plus 80,000 rand. That gives me 180,000. And another one there. Divided by 2. So if I divide it by 2, what is 180,000 divided by 2? That gives me 90,000 rand. So therefore, 90,000 rand is my market value. You see, so it's 10,000 more than trade, but it's 10,000 less than retail. That is how you calculate it. And make sure that you know this, because you might get questions about this in the exam. All right. Everybody happy? Sharp. Nominated value. In the case of a collectors or vintage vehicles, certain insurers are willing to insure a vehicle for more than retail or trade value because it is worth more. They would require a valuation certificate from a reputable dealer. The valuation certificate usually cannot be older than a year, and a new certificate must be supplied every year. Some insurers refer to this as the agreed value. So yes, some of those vintage cars are much. It's worth plenty of money. I know my dad, he bought a 1958 Mercedes-Benz 220S. He bought it for 3,000 rand, and that was his old age car, his pride and joy. He only driven with it on Saturdays or Sundays to church, for weddings, etc. The rest of the day he parked it there. That was his toy, his vintage car. But that car is now valued at 100,000 rand. Although it's a 1958, but go and have a look. What are they going for? They, depending on the condition, they go anything between 80,000 to 120,000 rand, depending on the condition. My dash is still original as can be, and is keeping it. So yes, some of these cars are much higher in value. Settlement value. In terms of this insurance contract, the settlement value refers to the total amount, the maximum indemnity that the insurer agrees to pay, from which certain deductions can be made as per the policy wording. In terms of the finance agreement, the settlement value refers to the total amount owing to the financial institution, including earned interest. There is certain deductions, and see it in your study material. That's why I say you bought the car for 100,000 rand, you finance it, they add 30,000 rand with interest. Now you owe the bank not only 100, but you owe them 130,000. And if you want to settle it, you need to pay the full 130,000. But depending on how much you paid off already, they will calculate it. But yes, it is the total money, not only the purchase money. They work in interest as well. But normally a settlement value is cheaper than paying the full term. So if you win the lotto, rather settle your car. If you can, you'll save a lot of interest. Additional items that should be insured. Any non-standard accessories must be specified separately on the policy, either under the motor or the vehicle section, or at some insurance under the all risk sections, and an additional premium is payable. And these things include things like car radios, CD shuttles, and speakers. Not that we don't get CD shuttles anymore, but yeah, there's some people that still use them. Some insurance will indemnify for these, but only up to a certain limit for R1,000. So normally, without adding them on, you already get R1,000. But if you want more, then you have to specify. And the normal vehicle excess applies, plus loss of no claim bonus. Special wheels, rims, or max, if not specified, it may be paid to a limit amount subject to motor excess or not at all. Additional items that should be insured, things like your tow bar, canopy, sunroof, nudge bar, running boards, leather seats, Bluetooth applications, satellite navigation systems, performance enhancements on the vehicle. So, what is the difference between a no claim bonus and a cashback bonus? So, the purpose of the no claim bonus, insurers like to attract and retain clients who do not claim. The premium of these clients contribute to profits and they are not a burden on claims and administrative staff and process. Yes, because they make money. You pay them every month and they don't have to pay out. You are like a cash cow to them. So that's why they give you something like a carrot in front of a donkey's nose. Come on, don't claim, don't claim. So for each NCB, in other words, for each no claim bonus, that's what NCB stands for. So for each no claim bonus year, a higher premium discount is allowed. So when a claim is reported, the no claim bonus is lost or reduced, and the insured must start accumulating bonus years again. So the higher the no claim bonus, the more discounted the premium. The client does not receive money back from the insurance in the form of a reward. So they just lower your premiums. So it benefits you in any case. Insurers are experiencing growing competition in the marketplace due to needs expressed by consumers for more flexible products. Consumers, especially low or non-claimers, increasingly expressed dissatisfaction for constant premium increases due to other claimants and no rewards to those who never claim. A cashback bonus is a financial reward given to you by the insurer should you remain claim free. Some claims are allowed by some insurers, so they will tell you these small claims it's still fine, but for the bigger ones it's not fine. So that you know what you can claim, what you cannot claim to stay remain claim free and get your no claim bonus. Effect of cashback policies. Clients find the cash reward attractive and behave responsibly to avoid accidents or prevent claims. It prevents a myriad of small claims being lodged with insurers, and clients carry the risk for these claims themselves. Reduction in claims is cost effective for the insurer. Less claims administration is required. So the less you claim, the more cost effective it's for the insurers, so the more money they make on you. You are their cash cow, their golden goose who laid the golden egg. They just get money and they don't have to pay back. There's less claims administration also required. The insurer promotes the concept of the profitable client and therefore positively affects bottom line profits of the company. With this concept, claim ratios like premium income versus claims payout improve, and this means profit for the insurer. It impacts the client who has almost reached the end of the no claim cycle, who then has a legitimate claim. He loses the no claim bonus and the prospect of a cash reward. Depending on the quantum of the claim and the value of the cash reward, he or she might decide to withdraw the claim. Liability cover. Some insurers automatically included liability cover as part of their comprehensive and limited car insurance packages. But you can also select this as standalone cover as well. You'll enjoy up to 5 million rand in liability cover for the vehicle that's insured by certain insurers. So even if you're driving a French vehicle and you can be held legally liable for causing an accident. You'll enjoy liability cover. So that is, um, that is for you. So if you're keeping liable, that you can pay out the people. There are various sections of short-term insurance, such as house owner's insurance, that covers your house, the actual building. Household insurance, the contents of your house, like if the furniture, all risk insurance, car insurance, actually vehicle insurance, personal liability insurance, and personal accident. So make sure you know the difference between house owners insurance. House owners is not about the contents, it's the actual building. If the building burns down, if there's a landslide and the walls fall over or something like that. Household, that is the contents inside the house, like your furniture, your TVs, your Wi-Fi, all those kind of things. There are different liability cover policies available on the market for specialized functions such as employer's liability, products liability, defective workmanship, and contractor's liability. And that's the end of this part two. If you've got any questions, you know what to do. Thank you.